Hey everybody, welcome. Appreciate everybody hopping on. We're excited to connect with everyone and just kind of share what we've learned. We're talking to brokers, every day, lenders. We're out in the market, looking at deals, and just wanted to, just kind of share what we've been up to and what we've learned, and hopefully that helps everyone. So kind of hop into this. Oops. Okay. So for me, agenda will kind of go over background, portfolio performance, economic outlook, and then strategies and kind of looking what we see kind of looking forward. So here's our background. So over 233 million in assets and a little over almost 2,300 units total, 7 full cycle. And so, yeah, we're just, excited about the opportunities, coming down the road, and excited about this year. So, again, we're going to talk about, kind of the portfolio today and moving forward. So here's the portfolio. So we have together under momentum, we have a little under 900 units. As you can tell, there is we're very specific about where we're at around Houston. We're all out in the burbs, and we're in Northeast Houston and Humble, in Cypress, and then in Rosenberg. So I'm really excited about those areas, those submarkets. If you line up all the deals next to each other, and we'll see this a little bit later on, if you line them all up, they look very, very similar, and that's by design. They're all, similar. It's low. The kind of the recipe is, low crime and good schools, and so we're just excited about the transformations that we've done with these assets. Yeah. Hayden, is there anything you want to add to this?
Yeah, I'll just kind of echo what Dustin had said. One of the things that if you know Houston, or if you can tell from this map, is we really like the suburbs of Houston. And then it doesn't have the streets on here, but the majority of our assets are often off of major arteries that actually feed into Houston. Rosenberg and Humble are right off 69. It actually cuts all the way across Houston, and that's something that's really appealing to us, because we want our residents to have a lot of access to the employment centers around Houston. 99 is the new highway that goes all the way around and runs right by Rosenberg. Henry at Liberty Hills on the northeast side there. That one's right off 90 in the Beltway, so you can get anywhere around Houston. And then Jones Road, the one in Cypress that we just closed on, again, it's sandwiched in between 290 and 249. So major arteries into the city center of Houston, but being out in the suburbs, which is what we really like, where you have really strong household incomes, you have master planned communities going in, and really great schools, and this is where families want to live. And then on top of that, when you look at even Texas and let alone the entire country, when you compare the cost of living to Houston and other places, it's very affordable. So a lot of new families, a lot of starter families are moving into this area. And again, we'll touch on some of the jobs and so forth that are kind of demand drivers, really driving the population growth down here in Houston specifically a little bit later. But these are all factors that play in our decisions and why we're wanting to grow in Houston. We'd love to buy in Dallas too, but we've got a lot of traction down here. And then on top of that, and we'll get to more detail, but it offers us a lot of benefits just from a management perspective and actually operating these communities. We're very hands-on. I actually just moved down here into December of 22, right around that Woodlands area at the top of the map. And then we've got an asset manager who is inside the loop, inside 610 on the west side of Houston there. So central to all the communities too, that touches every property. So we really like Houston, and this is where we want to continue to grow. And we'll get into some more detail about kind of why throughout this presentation.
Awesome. So here's the current performance for the portfolio. you can kind of see the lease trade outs. So one question we get from a lot of people, they're like, hey, because you hear in the news, so rent growth is decreasing, which it is decreasing. I mean, you can't keep up with 15, 16% lease trade outs and rental growth that we saw in 21. So obviously that's got to slow down. That's not sustainable. But we are seeing some pretty impressive lease trade outs, especially in Rosenberg. And and our occupancies are holding up pretty well. We just purchased, as Hayden mentioned, we just purchased Jones Road in late December. So we've really only had it for a month or so. We bought it and it was in the mid 80s, and we're working to get occupancy up right now. So, but overall, just been really excited about the lease trade outs, especially at Rosenberg there. So kind of just won't dive into it too much, but with that particular asset, we were really excited about that because they were charging what they were charging for classic units was the same as what they were charging for upgrade units. So all we created a spread. And so we're able to, we have spent a lot of money there. We've upgraded the clubhouse looks. We're just wrapping that up right now. The clubhouse looks fantastic. We put on a new roof and we painted the exterior. And so we have put a lot of money into it, but the interiors we haven't really touched yet. And so, but we're able to, just because they had the classic and the upgrade at the same price, we're able to just create a delta. And so that's kind of why we're seeing a lot of those really big lease trade outs. So anything you want to touch on?
Yeah, I think that's, a great point of the types of value that we look for when we're, identifying these communities that we want to invest into. We love Rosenberg. I've actually got family in Richmond there, which neighbors Rosenberg. So we've seen and heard about all the growth going in that direction. Everything's pushing down 69. So there's a lot of growth, a lot of great companies moving into that area. But then when we saw the rent roll and we saw that a classic unit is renting for more than a fully upgraded unit, and they just haven't really been pushing much because they had owned that deal for a while. That's the sort of value add that we get excited about because it's really a paper change and you're able to significantly increase the income at the properties. And then one other important thing to note about Rosenberg specifically too, the occupancy there, it's actually back up around 95% as of today. So just kind of depends on when you catch the closeout reports, but so it's doing great. And all our properties are performing pretty well. We just closed on Jones Road in December, so we don't have a whole lot of data there. When we took over, I think we're 83. Today we're already almost 88. So we're seeing already quite a bit of movement in just about a month. So really excited about all the properties. They're all doing really well. All well occupied and still seeing really good trade outs. Even on trade outs of leases that are already at market. We were just looking through that the other day, and they're still, I think 3-4% even on leases that are already at market, which is a really good sign because some communities are getting none. So really excited about all of our current deals, and we'll get into more about how we operate these again throughout the presentation. And to give you guys a little bit more insights on how we plan to maintain this throughout the year.
Awesome. So here are, everybody loves, good before and after pictures. So on the left is Deerbrook. It was, not the most inviting place when you kind of walk in, just, very, very ho-hum, and the furniture was very outdated. So that's on the left. And then the Henriette Liberty Hills is on the right side. So just lots of orange. And then so that's kind of the upper right's Liberty Hills. When you walk in, you see that kitchen kind of in the left corner. And then there's kind of a amenity space. There's a pool table there. That's also Liberty Hills on the right side. So those are before pictures. And then here are some after pictures. So very dramatic and light and bright and very modern. And so we worked with designers to help, put this together. We had, worked with Sane Construction. He was the general contractor on these remodels. And so, one thing that we have to kind of work around is, these are, especially Deerbrook, Deerbrook's 360 units. It's a lot of, it's a lot of units, it's a lot of people, and that office is very, very, very busy. And so it was great that, there's a lot of flexibility as far as some of their guys coming in on the weekends, when we weren't as busy to do flooring, or, just to kind of work around us. Deerbrook Deerbrook is in the upper right hand corner. So let me go back. So Deerbrook on the left, Deerbrook on the upper right. So we blew out that back wall there, so you can see that glass, very bright, very inviting, very, just modern. And we did lots of other upgrades kind of around the clubhouse to Mount Hayden, if you want to kind of touch on some of this.
Yeah, one thing that I think is important to note here, specifically about our business plan, is that, if you didn't know, you might think these are the same properties, and these are actually two different complexes. And like Dustin had said, this is all by design. And so, like you'll notice the blue paint color, it's called In the Navy by Sherwin-Williams. It's the same color that we use at all of our Henry properties. It's our signature blue. The flooring there is the same type of flooring from property to property. The actual furniture, it's article furniture. It's all from the same vendor. So a lot of this, all of this is what enables us to really speed up the execution of these business plans, giving them each kind of a unique look, but it's the same feel. Once a resident steps into a Henry property, they will know they step into a Henry property. And then from day one, we take over these assets. We're able to start implementing this business plan. We don't have to think through, hey, what colors are we going to paint the walls? Which vendors are we going to use for our flooring, or our paint, or our fixtures, or any of that stuff. So it really enables us to speed up the process. Like Dustin mentioned, on Deerbrook, that was a little bit more extensive renovation because we actually blew out that entire wall. One problem, if we could go back to the previous slide, is that's your view as soon as you walked into the clubhouse. So you're hit with a wall. It was dark. I mean, the blinds were half closed. It's just not a very friendly, inviting look, and it doesn't draw you into the community. And so one thing we did was we blew out the entire wall. So the first thing that you see, if we're able to go to the next one, is the first thing you see is that look, that view out into the pool. So we're constantly thinking about those sorts of things, about the experience a resident has the moment they set foot on a Henry property. How are we increasing their likelihood of leasing and staying with us? So it's a big part of what we're thinking about and what we're talking with our designers, but then also combining that with our signature kind of Henry business plan. It really enables us to speed up this execution, and time is really everything in these properties.
Awesome. So here's some more before and afters. So Deerbrook on the left, Liberty Hills upper right, and then Rosenberg bottom right. And all the pictures will be in the kind of the same place for the same for the complex. So Deerbrook left, Liberty Hills upper right, and then Rosenberg bottom right. So we actually just I think it was November or December, we finished up the paint on Rosenberg bottom right. So actually all three, I think, were wrapped up in the fall. So anyways, just this, all the paint, as you can tell, was fairly tired. The two on the right don't look too bad. Once you get a little bit closer to them, then you can see some things. But the one on the left, Deerbrook, was obviously very tired. That's a very overcast picture too, so that adds to it. But the paint was very, very tired. There was a little more carpentry work involved with that one as opposed to the other two. So and then obviously it helps with nice and clear skies, but it is very, very bright. It's a stark difference. One thing that was pretty interesting and pretty cool is that with once we repainted, especially noticed it with Deerbrook, once we repainted, it made the windows look new. The windows popped, and so it was pretty just interesting. So when we're all about first impressions, so people they drive up and they say, wow, it's we have very nice signage and all that, and a nice monument sign. And so you pull up, nice new paint, and then you go into the clubhouse, and then again it's like, wow, this is light bright, and great first impression. So I don't know if there's anything you want to add.
Yeah, just a couple of things. Just like you saw on the interiors, we kind of carry that theme of a rinse and repeat business plan to the outside. So obviously these are actually all very similar colors that we're using at these properties. So again, it takes the guesswork out of it when we go to take these over. And then what we also like about our color scheme that we use, which is this mix of grays with a splash of blue. As you can see on Rosenberg in the bottom right there, we got blue on the shutters, and then all of our entry doors and patio doors on both Deerbrook, on all the properties are that blue too. So it makes really nice contrast on the light grays. But it also enables us to, when we go to sell this, because we're always thinking about our exit. We're always thinking about where's the value for the next guy. We don't want to do everything, and we don't want to buy a deal that has everything done to it either. We always look for a value add so that we can force that appreciation. And so by simply changing out, for instance, on Deerbrook, if you change out the bump out colors there, and you've got a totally different look, and you spent a third of what it would cost you to paint that property. So we're always thinking about that too, and leaving a really nice canvas for that next guy, so that it increases the likelihood that they see value in it when it comes time to exit these properties too, which is, I think, very important.
For sure. Yep. Cool. All right. So we will, hop into the economic outlook. And so, I don't know what all you guys have seen. If you've been paying attention to interest rates, and then if you get Pensford's email, Pensford they have a interesting email. If you're a Cowboys fan, you may not want to sign up for it because he's an Eagles fan. So anyways, but he has lots of humor in there, so he's also a pretty funny guy. But anyways, but so we I can't remember if we got this from Chatham or Pensford, but anyways, so we follow the forward curves and all that. So I just wanted to show this is from earlier in the month. One thing that I guess we'll kind of preface this is, yes, they have this nice pretty curve and all that, and we know you can model stuff, you can put stuff into a spreadsheet, and then there's reality. And so this is the pretty spreadsheet that shows this nice curve, and that's exactly how life is, right? So anyways, but some other charts will kind of show you, hey, here's how it was modeled, and here's reality. So anyways, so kind of take this for what it's worth. But anyways, is there anything you want to add before we move?
Yeah, just one point to touch on too, is a little bit on and I think we'll get on in it a little bit more later too, but the window of opportunity that we see in the meantime, because as we can see, we're still on the upward swing of things. And every expert that we talk to, every conference that we go to, everybody says Q3 and Q4 of this year is when they expect activity to pick back up. And as you can see, that's kind of at the top end of that curve too. And so, as interest floods back into the market, so will prices too. So that is something to note. We think here at Momentum that there is a buying opportunity, and that buying opportunity is for sure on the upward swing of that curve. Hopefully there's some on the plateau there, but we do expect, and what we're seeing currently is a lot less active buyers, a lot less deals in the market, a lot more off market, and able to get away with a little bit more favorable terms to the buyers. So it's definitely switched quite a bit. And we kind of think, in our minds, as long as we're on that upward swing, it could be more of a buyer's market. But as we start to plateau or go on the backside of that curve, that may change some things.
Mhm. Yeah, I mean, just it's a matter of, it's risk and reward, right? So right now there's, the uncertainty is probably decreasing. The months back it was like, oh, is he going to do 50? Is he going to do 75? Is he going to do 25? Whatever. And so as we're getting into this, there's more and more certainty. And so, like Aiden mentioned, we feel like there's a window of opportunity. There's, some, and that's our opinion. So it's what you paid for it. So, but we've heard a lot of people, hey, I'm gonna wait till the back half. And, I don't know how long this window is and all that, but, once deal flow picks up and once, lending, is on a little, firmer footing, that's when you're going to see a lot of capital kind of rush back in. Okay, so we were just talking about pretty curves, and now so here's reality. So these are the last 4 cycles, forward curve versus actual. So hopefully this makes sense to you guys. But so the blue is the pretty curve that was modeled, and then the black is what actually happened. So as you can see, they were predicting this nice landing, nice flat curve, and then what happened was, things they had to, the Fed has, they have a lever, and so they had to pull it, and so that's what happened here. So anyways, it'll be interesting, to see what happens. We've been buying lower caps, and some people didn't buy caps. Some people bought 2-year caps. Some people bought higher end caps because they're the caps are expensive. So we don't know, and we'll kind of get into it in a few slides. We don't know at some point, right now, because we bought low caps, it looks good. In a year it might look different. So but for us, we want to feel, we modeled it with a lower cap, and we were, and we bid at the prices that we bid at with that lower cap factored in, and we felt comfortable. We wanted to be conservative, and so we wanted to err on the side of caution, because really, like, we don't know where interest rates are going to go. The Fed chair Powell said, November of 21, he's not going to raise rates. And then he turned around the next month and said, I'm raising rates. And so, does he really know what's going, if anybody does, it would be him, but I don't think, it's a best guess. And so, anyways, we just wanted to err on the side of caution. So we went ahead and bought lower caps. They are expensive. But like I said, we'd rather err on the side of caution, and as opposed to, being in a tougher spot. So I don't know if there's anything you want to add.
Yeah, I think ultimately with, this slide and the previous highlights is you've got to be prepared for the what ifs. And if you do exactly what the experts say, that might not be the best decision. And so I remember when we bought the Henry at Liberty Hills, that's when caps were dirt cheap, and you could get a really low cap for hardly any money. But back in that time, again, there was no future of hiking rates in the picture. And so a lot of people bought higher interest rate caps. But in our minds, again, we have to protect, as stewards of capital and operators of these multifamily properties, we have to protect our investors at the end of the day and ask those what if scenarios. What if the Fed doesn't stick to what they're saying now and they change their tune in the future? Just like this graph shows, in every single one of the last 4, really the last 5 cycles, at some point that tone had changed dramatically. And that's what we have to be prepared for. That's what we're currently going through. And this time is really showing and really highlighting those that did prepare for the what ifs and those that did not, just to get deals done. So For us, I mean, Liberty Hills, we paid $70,000 for a 50 basis point 3-year cap. We're getting that monthly now.
Yeah.
So it's paid for itself so many times over. And, it's a really good kind of indication of just, you don't always have to listen to exactly what the experts are doing. Take it all in and then poke holes in it. Ask those what if questions. What if, they keep raising interest rates? What are we going to do? What if they lower them tomorrow? What are we going to do? You have to have answers to all of those different scenarios. And that's, I think what these two slides really highlight.
Awesome. Okay, so, and then, again, past results doesn't necessarily indicative of future performance, but this is from Pinsford, so obviously we follow a lot, what they're doing and what they're talking about. I mean, he's his podcast is called interest rate podcast or something like that. So I mean, this is all he does. This is all they think about. So we follow them. We get their emails daily. So this is the first hike to first cut. So we had our first hike in March of last year, March of 2022. And so on, the longest that it went from first hike to first cut was 3.2 years. So, potentially we're, out to, can't do math when I'm on a webinar, but, was it, what did we say? 22. Okay.
Yeah,
So
May
25. Okay. So anyways, we have a few years. Is it going to go out that long? I'm not sure. We'll have to see. There are, there's a lag in everything that's occurred. We'll talk about a few things coming up, but it'll be interesting to see what happens. I know on the mortgage side, on the single family side, they've seen mortgage rates kind of start to dip some. And I think I'm not a mortgage, single family mortgage person, but, the guy I was talking to actually today was saying that he thought, mortgages were going to dip into the fours, later in the year. So that's not my expertise at all, but just, interesting. So I don't know if there's anything you want to add here.
Yeah, just the fact that, like Justin mentioned, the first hike was in March. So we're 11 months deep into this so far. And on average, it's 2.2 years. So, if that continues, we're looking at, early mid to 2024 before they start cutting. But again, to your point too, who knows? It could be longer, it could be earlier. I know the Fed acts month by month, so it's something that we continue to monitor every single month and see what they're doing, and then kind of take that information and decide what the best approach is for new deals and existing.
Okay, so, and here is the last hike to the first cut, which, last hike, potentially might be coming up soon, if you kind of listen to what everybody else is saying. So, on average, it's, around 9 months. So, everybody that we've kind of, and even so I guess kind of preface this with the people, Pinsford that's putting this out, is, he's kind of poked fun at himself and all that. And so, I mean, we listened to him very carefully. I think it was last year he was saying, he thought that the second half of the year, kind of midsummer, that's when we'd start to see stuff start to drop. Now he's kind of saying 2024. So, it's kind of it's a moving target. We're obviously watching this, very closely. We get daily emails, what our interest rate cap is worth, which is interesting to see. So, pointing back to the Liberty Hills interest rate cap that Hayden had mentioned, we bought that for $70,000, and that it kind of wavers in between, but I think right now it's around 900,000 in
Close to $1 million.
close to $1 million in value. So we bought it for would have been great to invest in, right? So, but yeah, so we bought that for 70,000, and like Hayden mentioned, we're getting paid almost, pretty close to 70 grand a month, and so anyways, we're just trying to educate you guys, and this is something we kind of follow all the time, and so I thought it'd be fun to share what we learned and what we're seeing. So anything else to add?
No, I think that's pretty much it, really. I think, I guess we'll see when they officially pause on the rate hikes. It would line up if they do over the next few months, put a pause on it. Again, everybody's been saying Q3, Q4 of this year, things are going to start to open up, and that kind of aligns with what history has shown us here. So again, when is the buying opportunity is really the big question in everybody's mind. In our minds, it's before that money floods back into the market, because again, it's supply and demand. As you have more demand, that's going to drive prices. And especially if lending hasn't figured itself out quite yet, it could make things very tricky as well. Right now we're seeing, and we'll get a little bit more into it, but we're seeing deal flow dramatically down. We're seeing more off market, more distressed opportunities, and you can just get away with a lot more. I mean, 12 months ago, you had to have 1% of your purchase price at least hard day one, the moment you signed a contract on it. That's gone away completely. Most of the time it's either after a due diligence or an early look period, but in the normal market, we weren't seeing that at all. And then, sellers are a lot more forgiving on the lending side too. On our last deal, we got a significant interest rate cap credit from the seller that we actually negotiated into the PSA. So that in the event that cap cost was moving around on us, we already had a credit built in with the seller. And that's another good thing about navigating and still underwriting deals during uncertainty, is you pick up on those things and you learn how to protect yourself. If we didn't have that interest rate cap credit, because we ended up having our lender, I guess you could call it, retraded us and moved our SOFR floor up, which meant if SOFR dipped below that, our interest rate would actually go up. So we wanted to buy out that floor. And if we hadn't negotiated that credit on the front end, that would have cost the deal a lot of money, and that would have really hurt. But thankfully, we had been through this before. We had seen what happens with interest rate caps, and we were able to protect ourselves and our investors a little bit better. So that's one real big positive with, going through these challenging times, still looking at deals, still being active, talking to brokers, talking to lenders. We were talking to lenders just today. So we are big believers in never really putting pencils down. You've got a great analogy, actually, if you want to share about professional athletes.
Yeah,
I really like.
I'll probably butcher it here, but yeah. So I mean, it's kind of it's like if we're football player, professional athlete, if they were hurt, it's not like and obviously we're not professional football players or athletes or whatever, but if you're a professional athlete, you're not going to just go sit on the couch and eat popcorn. I mean, you're going to be watching film. You're going to be, rehabbing what you can rehab, even if you're injured. And so it's kind of the same thing. It would be, just because things are a little choppy or whatever, whether you buy or not, that's a different question. But, you can always learn something. And so, it's just kind of, to us, it doesn't make sense if waters are choppy. You go out there and learn and you adjust and you navigate. And like I said, whether you buy or not, that's a separate question, altogether. But you can always learn something. And it's, like we were during COVID, we were still underwriting. And this honestly feels very similar to COVID. Lending, actually lending was maybe a little better then, but there was no deal flow at all. And it was just, it was, just a very, very interesting time. And we're seeing, honestly, we're seeing, we've seen some kind of cap rate comparisons to Q1 of of 21 versus now, and the cap rates for the stuff that we buy is actually very similar to during COVID. So we're seeing some very interesting pricing. There's not a ton of deal flow, but the deals we are seeing, the pricing is very interesting, and we haven't seen this sort of pricing in a while. So I mean, I don't know, we're just not not proponents of necessarily just sitting there and going to eat popcorn. We're going to be active. We're taking our but we are very, very focused on operations right now. There are some headwinds in the market and things like that, and so we've really bared down, and we have a staff event tomorrow. We're taking everybody out for bowling and food, and just to kind of a lot of our staff, they're really good, and they have options for they can go work somewhere else. And so the event tomorrow is to build those relationships, strengthen those relationships. So when they do get an offer, they're like, hey, we really like these guys versus we're improving the properties, and we've got some pretty neat initiatives coming up. So okay, so back to interest rates. So just I wasn't a physics major. Did go to school for engineering, and so this is the pace of their hikes have been pretty traumatic. Not unlike COVID, just going in kind of the other direction, right? So I guess when you just kind of think about a pendulum, and we kind of think of if it pushes hard one way, maybe the inflation, all this other stuff will absorb it, but it feels like if you push hard one way, it could come back pretty hard the other way. And like I said, maybe inflation kind of absorb some of that. So we'll TBD, but their hike has been very, very aggressive. And so, and this kind of shows what hikes have looked like over the last 5 cycles. So we thought this was, if you're kind of a data geek or whatever, I think this is pretty cool. And so I don't know, it'll be interesting to see what happens during COVID. Obviously, everybody probably remembers that, one day everything was pretty normal, traveling, all that's, going to the grocery store, movies, all that stuff. Then, very quickly, everything stopped, and people stopped spending, they stopped taking vacations, and they saved up a lot of money, and people weren't moving, and it was just weird. And then it felt like all of a sudden everybody was out traveling, out buying houses, and just all that pent up demand just was released. It felt like a very short period of time, and you saw home prices going for 100,000 over, and things like that. I don't know if this is what this is exactly, but they did push very hard one way, and so it'll be interesting to see if it swings back the other way. Do you have anything to add?
Yeah, just to kind of echo, this is the fastest tightening cycle in the last 35 years. So to your point, it's once on the backside of COVID, the demand floodgates just opened up, and now the Fed is stomping on the brakes right now. So again, the pendulum swung one way very hard during COVID, and now it's swinging the other way. So it'll be really interesting to see if they get this right and where this lands. But all of that is again to be determined. And then we can talk about on the next slide kind of yield curves and see what traders are thinking too. Okay.
You want to take this one?
Yeah, so this is interesting. Just again, not something by any means we're experts in, but we do pay attention to, and a lot of those experts do say this kind of indicates a recession is coming is when the yield curve inverts. So as you can see there, you get the 10-year on the bottom, and you've got the shorter term 5 and 7 higher than that. So that basically means that a lot of traders are seeing a lot more near-term volatility And so they're rushing to longer term treasuries, and the yields on the shorter ones are going up. So, what we take this as is, the likelihood of a recession. Again, this is just kind of a leading indicator that could be something down the line and something to be prepared for too. Obviously, if that happens too, then the likelihood that there are cuts in the rates probably goes up as well.
And then, so this is the employment change for the top 10 metros. We focus our kind of two metros are Houston, DFW, and they seem to always lead the nation in terms of population growth, employment growth, and I guess just kind of, one thing to point out is, New York lost a lot during 2020, and so they're 21 and 22 are basically kind of getting them back to neutral, back to zero, and then versus DFW and Houston. DFW, let out the two led a little bit. And so, they obviously, they lost some, during 2020, but then gained back and then some on top of that. So, and then, LA is kind of in a similar spot. They're, kind of lost quite a bit during 2020. They've gained a lot, but they're just kind of back to, pre-COVID-ish. So anything you want to add?
Yeah, I think this is just good kind of fundamentals that support our investment thesis, which is Dallas and Houston. That's really what we're focused on. This data is courtesy of RealPage. They put out a lot of good information. And like Dustin pointed out, you got New York, LA, Chicago, Boston, all essentially getting back to where they were pre-COVID. But Houston, Dallas, and Atlanta are exceeding where they were even back then with the losses. So we just we're big believers in Texas. We're big believers in Houston and Dallas in general. I think they're both great markets, and we just really like seeing the data kind of supporting that too. So a lot of people still moving there, a lot of great jobs being created, and it's where we're looking for the foreseeable future.
Yeah. Awesome. And then this is just kind of showing rent growth, Houston MSA, obviously everything, there was a pretty nice bump. We're kind of, we get actually a lot of questions, hey, about, Class A. I'd say we're kind of, the deals we're chasing are kind of A-, B+. So if you remember back, a lot of our rents are kind of in that $1,300-$1,400 range, which is kind of, if you look, it's a little bit below that, Class A. So, we like it. We think it's a good space. There's, a value add component. I mean, our thesis is, pretty simple. I mean, we're looking for deals that lag the market, and we never want to lead the market. All we want to do is go from the bottom, and we just want to go into the middle. That's it. Because we still want a buffer above us. And so, we've seen that, time and time again. There's a deal we've owned for a few years now, and people were, hey, what happens if someone builds a new asset? And so someone did build a new asset, and they're leading the market. Because it's expensive to build, and then inflation has further pushed all that up. So they just kind of raised our ceiling and made the submarket nicer, actually. So I don't know if there's anything you want to add to this.
No, I think you covered it.
Okay, cool. And then with kind of with rental growth declining, and all that, we've seen occupancies have starting to dip a little bit, and they do typically kind of there is a dip around the holidays and all that. The leasing season will come up in March, and then we'll see things typically kind of pop up again. But yeah, anything else you want to add?
Just this is going to be a main focus for us. All of our assets, aside from the unstabilized one we just bought, but all our assets are doing really, really well. So it's something that we we press on, pretty hard at all of our sites, but, Houston in general, it looks like we're, right around that 93, 94 mark. And that's, a little bit below what kind of the average of where we're at. But, we always tell our managers we want to, and we've got bonus structures and incentives, all designed around being 95 or greater. So that's really what we shoot for. And kind of are hanging out right around that number for the most part.
Yeah. And just to, in order to kind of maximize what we have and all that, we're just, we're very focused on operations. We have, one of us is at each, we're big on touches. So one of us is at the property every week. And then we have calls with our managers as well. But one thing that, Hayden actually did very recently. So he went to each property, and it seems like a simple thing, but he went to every property, and just to, obviously they know who he is and all that, but, wanted to go through the process as if he was a tenant. And so, didn't find like any huge discrepancies or anything like that, but there were, there's some things that could definitely be improved upon. And then also, again, just with the whole, we're very big into systems and processes, and we want to make sure that every property is doing everything exactly the same way. We do that. Just it makes our jobs easier, makes our asset managers' jobs easier, makes the manager's job easier, and then that way, if they have any questions, they can talk to one of the other managers or our regional or us to, because everybody's on the same page and everybody's kind of doing the same thing. So. But yeah, it was just a nice, good exercise, and it's a way to kind of up our game as well. So Houston, seen, obviously a ton of population growth, prior to, I forgot exactly when it was, but basically 2010, 2020, Houston saw, I think it was roughly around, 1 million people or so. And that trend, as you can see, is continuing, over the next 10 years. DFW and Houston have really led the nation, and there's some other submarkets that have had pretty substantial populations growth. Phoenix is always at the top as well. So okay, so kind of we've talked a little bit about our acquisition strategy and all that. Super focused, and you were like, oh duh, no brainer, but we're huge on location. We can always talk about, we're like, hey, you can pour a bunch of money into the property, but you can't change the location, you can't change your schools, can't change your neighbors. And so we really want to make sure we get that right. There's a few assets that we could have purchased and we did not purchase because we couldn't get comfortable with the area. And for us, it's not worth it. We're not, we're not going to compromise on that. So, just really big on location. And then sometimes like the area is pretty good, but you can't find the darn thing. And so that's, obviously that's a problem. If we're having trouble finding it, then how's a prospective tenant supposed to find it? So, and then we pay very, very close attention to demographics, to income, we're looking at growth, we're looking at schools and all that good stuff. And then, as you guys saw, it's hard to tell which building was which, and that's on purpose. We're buying, it's the same type of building. And now, and because we're not spread all over the country or anything like that, a lot of time, like all the last 2 deals, maybe 3 deals, the last 2 or 3 deals that we've purchased, we've bid on those comps. We've bid on some of the comps. And so when the broker showed us the deal, like, oh yeah, we love this area. We love that deal. And, and the deal that they brought us is even better. So yay. So, I know we're looking at one deal that it's the same builder as one of our other properties. So we know exactly, what we're getting into, what to look for. And, so it just makes our job easier, makes our GC's job easier, and we can move very, very quickly. So anything you want to add?
Yeah, I think one thing that we're kind of seeing is the importance of being very narrow focused on your acquisition strategy, because we kind of got hit with the perfect storm of circumstances. You know, we had COVID, which nobody knew what that was going to look like. You know, how the rent relief programs were going to kick in, and what that was going to look like for collections. And then as a result of a lot of those programs, a lot of tenants actually got trained not to pay their rent. So there was a lot of issues with actually getting people to pay their rent. I mean, we had some residents that would walk in with a $10,000 check, and you know, most of these people live paycheck to paycheck. So and we know they had jobs too the whole time. So you know, we thankfully we only saw a little bit of that. Most of our residents, you know, paid on time, and you know, still had their jobs, were able to work from home. But some communities, especially older communities, we saw did not fare so well. And so you know, on top of that, then you know, so we had you know, bad debt started to go up on a lot of older assets. And you know, the operations, if they weren't really tight, we're starting to see some deals that are getting sent to us that, you know, the interest rates and just poor operations have really opened that wound quite a bit. So a lot of factors are all hitting people all at once right now. And so it's really, really important to have a really narrow focus, have really strong operations. Because for us, you know, these three criteria for us were, you know, we did not want to compromise on any of these. We wanted to be in strong locations where they had strong demographics, household incomes, and so forth. And then we were all chasing like type assets, because the more that you deviate from your focuses, it's not to say that you can't make money on older assets by any means, but the more you deviate, the harder it is to be successful and to really have a good understanding of what's going on at the property level too. Because we just week to week, I mean, we have weekly calls with all our managers, and a lot happens on any given week. And the more you have a wider focus, the more complicated that becomes. So we're really big believers on having a very, very narrow focus. And then, you know, like Dustin said, all our systems, all our processes are the same, so that, you know, if one of our managers doesn't know how to do something or needs to run a certain report that she doesn't have experience with, she can call one of our sister properties and get the help she needs, which makes a really, really big difference when you're actually operating these properties. And you know, yeah, like going to the properties and actually, you know, touring as a prospective resident seems really small, but you know, you would think that a lot of times, just because you say something, you'd expect it to be done that a certain way, right? But sometimes you get there and that's not the reality, or that hasn't been implemented. And if you're not going and checking on your properties and going through these motions routinely, you know, stuff starts to fall through the cracks, and you start to realize that, oh, wait, that things aren't being done how I thought they were being done. And that's when problems start arising. So we like to get out ahead of that. That's why we're always on site on our properties, looking over these construction projects, looking over our operations. We've even got it so detailed that we break the month out with our weekly calls, so that throughout each month, we're talking about different topics as the month progresses. Because for instance, if you look at delinquency at the first week of the month, at the first, it's really an irrelevant statistic to look at, because you've got a lot of rent still coming in. So it's going to be an artificially high number, and it's not worth a ton of attention at the first of the month. But by that second or third week, where you start to determine who's not actually paying their rent, that becomes more and more of an important statistic to look at. And so that's a big part of our strategy too, is, you know, having these systems, having these processes in place, so as soon as we take over an asset, it really becomes plug and play from there.
Awesome. Let's see here. So yeah, we were talking, you know, quite a bit about operations and all that. You know, just really big on, it's much better, obviously, to retain our current residents as opposed to going to get a new one, or new residents. So we're just really big on, we're doing monthly events at each property, and that's part of, we've built in, that's part of the bone structure for our managers. So and that's something that we ask about every month. So we're really big on that. And so we have a social calendar where we have a graphic designer that's putting out graphics for the social calendar and all that good stuff. So we've got a lot of really good systems in place, and I think probably over the past I mean, we were always focused on operations, but we saw as things really started to tighten and interest rates were going up, like we put a major focus on operations. So so we're excited about kind of moving forward and all that. On our team, we're fortunate enough, we have a dedicated regional just for our assets. So we're super excited about that. That just happened pretty recently, and we're just keeping tabs on everything. If whatever if you don't focus on it, it's won't grow. So I don't know, anything else you want to add?
Yeah, just the fact, I think 2023 and maybe 2024, but it's really going to be the years of operations. Those who operate will survive, those who don't might not. Unfortunately, there's definitely a lot of headwinds out there. The waters are definitely a little choppy, but those who operate will continue to do well. All our properties are in pretty good cash positions and performing really well. But on the flip side, we've seen some that are the opposite end of the spectrum that are not doing well at all. So I think really throughout the rest of this year and beyond, it's operations need to be a major focus. And it's something we've been done and been very proactive about it ever since even taking on our first asset together. But really getting our systems in place and not needing to grow too fast too. We're okay just getting into deals that we feel really good about. So I think that's a big part of the puzzle too, is growing at a pace where you can build that infrastructure that you can grow upon. So like Dustin had said, we've got a dedicated regional now that's overseeing just our properties. We're able to work with her to actually create different events and different processes for her interacting with our managers too. She's able to give all of our properties the attention they deserve. We're not being split between other owners. Yes, we do third party our management, but we really treat them like our people, which I think everybody should, honestly. Sometimes a lot of operators, they will third party and say, that's the manager's job, I'm just going to rely on those guys. And that's not how we approach it. Like Dustin had mentioned earlier, we're taking everybody out to bowling. That's not something that Asset Living, our third party management company, that's not something they put on the schedule. That's something that we came up with and wanted to do for our people, because we see them as our team. They're excited. It's really cool to see our staff excited about working for a Henry property and being proud to wear it on their shirts. And that excites us to see their passion for the properties, because then they take care of the residents, and ultimately the residents take care of everybody else. So, it's something that we are very adamant about. We take a very hands-on approach. Our asset manager, he actually has previous experience with Camden and Hilltop too, so some very big groups, and he's given us some great ideas too. So we're very excited and grateful to add him to the team. And we plan on continuing to be extremely hands-on, getting him trained up so that as we grow, again, we can maintain that level of service for our managers, for the residents, and for our investors.
Awesome. And then we're almost wrapped up, but just wanted to mention that deal flow is way down. I don't know, what people know and all that, but so typically, deal flows down, probably, 60, 70%, maybe more. At least it definitely more compared to 21, and 22, or yeah, 21 and early part of 22 when deal flows was nuts. So very little deal flow. We are seeing some distressed deals. It'll be interesting to see, what happens. I think the deals that that are distressed and not in great cash positions, and they didn't really buy interest rate caps, and just to, maybe some people don't know what an interest rate cap is, so I'll just kind of throw a number out there. So we buy interest rate caps, we buy lower caps, and so basically we had to pay. It's not free, nothing's free. So we had to spend quite a bit of money. So on one particular deal, our all-in interest rate is 4.4%. We had to pay $2 million for an interest rate cap in order to get it down that low. But that's something that we felt was the deal. The numbers worked, and that was already built into to the analyzers. So for us, that made us feel comfortable with the deal. But some people didn't buy caps, or they bought 2-year caps, or they bought very high caps. And so there's a few ways to skin the cat. So instead of spending 2 million, we could have another way could have been to put that money into a bank account, and then as we need it, which we would need it immediately, just because of interest rates. So we'd have to kind of feed, that, every month. But we felt comfortable. It's basically insurance. And so it capped our interest rate 4.4% for 3 years. So anyways, we that made us, feel very comfortable about the deal. But like I said, some people didn't buy caps. Some people bought very high caps, to where instead of, they spent money on a cap, but instead of, if they bought let's just say a 300 basis point cap, instead of 4.4%, they were probably around 6.5% or so. Depends on their spread. So, but yeah, so anyways, it's interesting. It'll be interesting to kind of see what happens as far as deals and all that. We are seeing some deals that are stressed. We were meeting with brokers today, and they were telling us the same. And then did want to mention that I don't have a way of confirming this statistic, but there are a lot of deals coming up with maturities here in 23 and 24. We saw some statistic where a quarter of all loans are coming up within the next 2 years. Not sure if that's correct or not, but talking to the brokers that we talked to earlier today, they were definitely saying there's a lot of maturities coming up here soon. So there should be, whether people want to or not, there's going to be some potential deal flow coming up. So anything you want to add, Taden?
Yeah, these are really the three kind of scenarios that we're just seeing. So, obviously deal flow is down significantly. We're still in talks with the brokers, and I do think a lot of deals are going to get done off market too. We're starting to see some of that. So getting out there, pounding the pavement, having those calls, having those lunches with brokers, I think is going to lead to the opportunities, the good ones this year for sure. Because the bulk of the deals, that 60 to 70% of people are in that waiting kind of holding pattern, where everybody hears Q3, Q4 things are going to improve. Well, sellers are hearing that too, and so that's what they're waiting for, because in their minds they think pricing is going to potentially improve for what they could sell the properties for. So a lot of people are in that waiting category right now, but again, especially depending on what interest rates do, that necessity category is there's definitely going to be some in that category. The highly distressed is not something that we're as interested in, because most of those that we're seeing are older properties. We don't see a ton of that in our kind of first gen value add 2000s vintage, but there may be too. And if there is, maybe from bad operations or just mismanagement, that might be something that we could be interested in too. But for the most part, the highly distressed stuff is not something we're too interested in right now, unless again it's up the fairway for us. But most of the stuff that we're seeing is along the lines, it's kind of in that necessity category. They've either got a fund that's closing out or a loan coming due are the primary reasons.
Yep, yep. And then just again, just kind of want to mention, pertains to deal flow and all that. We're seeing pricing. We're seeing some pretty interesting pricing, especially compared to 2021. So we're excited about that, and we haven't seen this type of pricing in a while. So we're excited about that. I think there's an opportunity, how long that opportunity lasts, how long the window lasts, we don't know. But we do think there's an opportunity, and then regardless, like I said, whether you buy or not, I think, we think it's a mistake to just sit on the sidelines, because you can always be learning, you can always be watching, game film, or kind of run through plays. So but I think there's always things you can learn and get better, and we're really big on just trying to optimize everything we have, and just trying to get better every day. So here's our goals. We're kind of a little over time. We'd like to, buy 2+ assets this year. We're, really want to kind of be in that 94-95% range for occupancy, and continue paying out, distributions. Don't want it to, it's not all rainbows and unicorns. It's, there's bumps in the road for sure. There's insurance gone up, but then we're able to potentially offset that with property taxes. So and then, like we were kind of talking about earlier, there's the Excel spreadsheet, which is pre-graph, and there's reality. So we try to do everything we can to prepare for what that reality, what if scenarios that Hayden was talking about. But we're always learning, trying to get better, and always just trying to talk to a bunch of different people, people that specialize, in their field, just trying to learn as much as we can. So anything you want to add?
Yeah, just the fact that, obviously, we're big on continuous development and growth. So we would like to continue to grow, but if that's in growing our operations and our systems and processes, that's fine by us too. So we just look to grow in all categories of life, and our business as well. So that's kind of our main focus. We'd love to hit these goals too, but this is really what we're going to be focused on throughout the rest of the year. So we're hoping to find some great opportunities, and we are seeing some interesting ones for sure. But again, we're going to be cautious. We're not going to rush into anything. We don't have to buy a deal. So, that's top of our mind as well.
Yep. Awesome. Well, appreciate everybody. And thanks for hopping on. If you have any questions, this is recorded, so we'll send out a recording as well. But if you have any questions, just shoot us an email or set up a call. Happy to chat, and appreciate everybody, and have a good night. See you. Take care.
Thank you, guys.
Bye.